In the last little while, I've had a lot of conversation with people asking me whether or not they should sell their house because they're worried about what's happening with mortgage renewals. Now, as a pro tip, please don't ask your real estate agent whether or not you should be selling your house. That's like asking a barber whether or not you need a haircut. Like, joking aside, it is a pretty serious situation, and I'm not comfortable answering that question, especially generally, because it really comes down to every person's situation. So I'm talking to an insolvency trustee, and the reason I'm talking to him is because I've already talked to a lawyer that talks about power of sales, which is your first step. You want to get ahead of a power of sale if you find yourself in a precarious position like this. And if you don't, then this is who you're going to be talking to at a much later point. The reason I talked to him is because I wanted to determine how should people think about what their risk tolerance is and how much they are at risk right now with the economy and the way things are going. The simplest way to answer it, I think, is it comes down to your conviction about the real estate market. So if you think that the real estate market is going to go up, that's one way to deal with it. And that's one way to deal with whether or not you should be selling your house. And then if you think the market's going to stay flat or go down, then it's a completely different conversation. The point here is I want to help people understand that whatever you do now or you don't do, it's going to have an effect on you one way or another, short term and long term. So hopefully this conversation with Doug will help you understand what your options are so that you can make the best decision for yourself and your family. And as always, my name is Vas. I'm a real estate broker right here in the city of Toronto, where I help investors and families navigate the real estate market. Enjoy the conversation with Doug. I want to come at this conversation from the perspective that obviously for the last 2 years, nobody was hurting in the sense, like from the homeowner side, right? Because we had so much equity in our homes and nobody was forced to do anything. The party has come to an end. You're, I think, the last stop. At least that's how I see it, but maybe you're not. And this is where maybe you can correct me. But I want to give you 2 examples in terms of what I'm seeing happening. And then I want to see, are you then the last stop for these people, or is there something else? So the big problem in real estate right now is you have the people that are under the most amount of pressure, the ones that took on multiple mortgages to buy a home. So the ones that are super leveraged. So we're talking people that are now underwater. The second position lender is not willing to renew the mortgage. And then there's 2 options. They basically have 30 days to try and sell the home themselves, or a power of sales being forced on them. So I know right now on the homeowner side for you, you don't get as much inbound. But where throughout this process does a homeowner reach out to you?
Yeah, and we can certainly talk about that. I mean, the short answer is everyone should just reach out to me wherever they are in the process. And in 5 minutes, we can tell them, oh, you're too early, or we can't help you, or whatever. That's the short answer to it. So, because every situation is unique. And so it's like saying, well, how much should you pay when you buy a house? Well, I don't know, like, give me some details. Tell me about the house. Tell me about those sorts of things. I think it's the same here. There's a bunch of questions we have to ask to kind of fill in the blank.
That brings me to my point. So for me, insolvency and debt relief experts have always been a bit of an abstract term. Mm-hmm. So in your words, let's just talk about, forget homeowners, just in general, how do you help people?
Let's talk about it in terms of the continuum then, I guess. So if someone has more debt than they can service, which is all of my clients, obviously, the first option would be fix it yourself. So that would be, well, sell your house. You got lots of equity, pay off your credit cards, you're good. Or cash in your RSP, cash in your TFSA, borrow from your friends, borrow from your family, whatever. When it gets to be the point where, well, I don't have any more assets to cash in, there's nothing more I can do, that's when you come and see me. And there's 2 things that we do formally: a consumer proposal and a bankruptcy. That's it. Bankruptcy, people sort of kind of understand. It's like, well, I lose all my stuff. Yeah, pretty much. If you have significant equity in your house, when you go bankrupt, you lose your house. That's kind of how it happens, which is why nobody who owns a house is going bankrupt right now. Because even with the recent market correction, people still have equity. The other option is a consumer proposal, which is a deal we make with the people you owe money to. So standard example, typical example would be somebody has $50,000 worth of debts, credit cards, bank loans, taxes, payday loans, whatever. We go to the creditors and we say, hey, look, I can afford to pay back $18,000. I'll pay $300 a month for 5 years. And the creditors say, well, I'd like to get all my money, but if I don't take this deal, you're going to go bankrupt and I'm going to get less. So I guess I'll take the deal. So those are the formal ways that we help people. Now, the informal ways we help people are someone comes in to see me and I go, well, you got $50,000 worth of debts, but you got $300,000 worth of equity in your house. Maybe you should talk to a mortgage broker and see about refinancing. You don't need to go bankrupt. So we also will direct them to other professionals who can help them given whatever their specific situation is.
Okay. Okay, that's helpful. So can you give us the lay of the land? And by the way, I want to preface this. I watched your predictions video with your partner. So I got some good takeaways from there. I'm well versed in it, but can you give us the lay of the land? Because I think when people, like, for example, there was a stat that came out today that consumer insolvencies had a big jump in November. This came out today. But without context, it really is very meaningless, right? Because I looked at some of the graphs you guys posted pre-COVID, since COVID, and where we are now in terms of insolvency and debt relief. Can you just paint the picture for everyone so that we understand where we are in this cycle?
Sure. And I don't know if it's possible to share my screen and actually put these charts on the screen. I don't know if that helps or doesn't help, but I can.
Sure.
Your question was, where are we at with insolvencies? So this is consumer insolvencies in Ontario. And you can see that in the month of November 2022, which is the most recent data we have, there were 3,372 individuals who filed an insolvency in Ontario in November. In 2003, in the month of November, it was about the same number. So over the last 19 years, the number hasn't really changed much. Now, of course, when you look at the graph, you go, yeah, wait a minute. The big spike in the graph is 2009, 2008, 2009, during the credit crisis. There were looks like 7,000 people who filed that month. That's twice as many as this month. Well, yeah, obviously there was if you look at it historically, since the 1990s up until 2009, the number of insolvencies was increasing. And then from 2009 until 2018, the number was decreasing. So there was a huge wave and then a wave down. The number of insolvencies started to pick up again, and they were growing pretty heavily when we got to 2019. And then boom, we had the lockdowns and the number of insolvencies collapsed. So one of my criticisms of the media is they will report something like, oh, insolvencies were way up last month. Well, that's like saying it's the month of January. The temperature is a lot colder than it was in August. Yeah, that's true because there's some seasonality to it. What you have to do is compare the temperature in January of this year to all the other Januaries to see what the real trend is. So you have to compare Novembers to previous Novembers. And yes, the insolvency rate has ticked up a little bit, but it hasn't got anywhere near where we were pre-COVID. And in fact, if you zoom in and just look at, they were going up, then we hit March of 2020 and boom, down they went. And they have been sort of, in a jagged fashion increasing. So again, the most recent numbers we have is November of 2022. That is the highest month we've had since the lockdown started in 2020. So the trend is definitely towards increasing consumer insolvencies, but we are not back to where we were pre-COVID, and we certainly aren't anywhere near where we were at the height of the credit crisis back in 2008, 2009.
Can I ask you if you can go back to the prior chart? Because there's a burning question I have for you. So all is good, all makes sense. The concerning part for me is I didn't realize that in 2019 we had a brewing issue. So what would you attribute this to? Because I have a feeling that if this issue was in 2019, we're likely going to go right back to it. If not, because I feel like COVID and everything that happened would have exacerbated what we have here now. It probably should be worse. Would it not
Yes,
be?
I think you're exactly right. Well, okay, so let's take a walk through memory lane here. Let's go back to before you and I were born in 1961, which is the data I've got from Statistics Canada. This is the household savings rate. So between 1961 and 1981, we Canadians were saving money. And we got to the point where we were saving over 20% of our income by the time the 80s started. And then from the 80s until just before COVID, we depleted our savings. So in 2018, the savings rate was essentially zero. And then 2020 comes, the lockdowns hit, and bam, we get to the highest savings rate we've ever seen. Canadians were saving more than 25% of their income when you look at the middle of 2020. Why is that? What's going on? Well, I couldn't go anywhere. I couldn't go on vacation. I couldn't buy anything. I was working from home, which was great. So I didn't have to pay for daycare or gas for my car or anything. And most importantly, I was really worried because I thought the world was coming to an end. So I wanted to have as much money in the bank as I can. So during 2020, we deleveraged, meaning we paid off our debts and we increased our savings. Now, of course, as the lockdowns ended and the economy sort of started opening up again, you can see that the savings rate has dropped so that we are now back closer to a 5% level. And if you look at the other side of this, which would be credit, consumer credit was growing. And then in 2020 and 2021, we delevered, meaning we paid off our credit cards. We got out of debt as much as we could, again, because we couldn't spend money. But then once 2022 got here, guess what? We started borrowing again. And as a result, consumer credit now is as high as it's ever been. And if you were to zero in just on credit cards, same story. Credit card debt was going up, and it sort of spikes around. I mean, it goes up higher at Christmas and lower in the spring and things like that. We got to a huge number. The lockdowns happened. We paid down as much of it as we could. But then since then, we've been racking up our credit cards again. And in fact, the most recent data that we've got shows that credit card debt is now higher than what it was before the pandemic. So the interesting question then is, well, if credit card debt and all other debt is higher than it was before the pandemic started, why is it when we look at these insolvency numbers that we are not back to where we were? That doesn't make sense. And the answer is, well, there's a time lag. It takes time. So I would predict that if we looked at levels of debt and levels of consumer insolvencies over the rest of 2023, they will both continue to increase. But it takes time. It's not an instant thing.
And that lag, what would you say is the regular lag for the data to flush through?
I've done a lot of work on that, and I can't give you an answer because there's so many different moving parts. But if you wanted me to pick a number out of the air, I would say, well, it's somewhere between 6 months and 18 months. So, I mean, think about in your own situation or somebody that you know, they lose their job. Does that mean they're homeless the next day? Well, no, of course not. I mean, I've still got some savings. I've still got access to credit. So I'm still able to borrow for a while until I can get caught back up. But so if it goes on long enough, then it becomes a serious problem. So I think this lag will go for a considerable period of time. Now, the other aspect to this is the asset side of it. So we're looking at the liability side of the balance sheet here and debts. Well, during 2020 and 2021, the stock market was doing great if you bought the right stocks. The real estate market was doing fantastic. So even if I bought the absolute worst house in the worst neighborhood and I leveraged myself right up to the top, I still made money. I couldn't lose. So even all this debt didn't really matter if your assets are going up by an even greater amount. But of course, if the real estate asset that's been supporting a lot of people is going the other way, then you're going to see an increase in insolvencies. And again, as you know, the number of people who are becoming insolvent who own a house is pretty much zero. So if you go back to 2011, about a third of my clients owned a home at the time they filed a bankruptcy or a consumer proposal. So they'd come in to see me and say, "Oh yeah, I got $50,000 worth of credit card debt. I can't pay it." And I'd say, "Oh, do you own a house?" "Yeah, I do." So we get them to get an appraisal, show me the mortgage. It's like, "Okay, well, your house is worth 300,000, you know, you got $10,000 worth of equity. No big deal. What we'll do is we'll offer a proposal to the creditors where you offer to pay back 20,000. You get to keep the house. Everybody's happy." But in 2021 and 2022, when someone came in to see me, I'd say, "Well, what's your house worth?" $1 million. "What's the mortgage?" 500,000. "When did you buy it?" 15 minutes ago. "But it's gone up in value by $500,000 in 10 minutes. Well, you've got so much equity, you don't need to become insolvent. You're not insolvent. Talk to a mortgage broker, refinance the house or sell the house, pay off your debts. You don't need me. Which is why for the last couple of years, the number of people who own a home who've been filing insolvency is practically zero. Now, it has started to tick up a little bit. We're now back into the 2% range. But again, historically, that's nowhere near where it's been.
Yeah, I saw that in your predictions video. You said that 2022, I think you were at 2.6%. And I found it fascinating in 2011. I think you said 1/3 of your clients were homeowners at the time, just like you said. So is it then almost safe to assume that, I guess, I don't know what number to put to it, but unless values drop substantially, maybe another 20-30%, for the most part, homeowners, unlevered homeowners, are going to be spared, aside from the ones that really levered up, immaterial amount, I'm assuming. Is that safe to assume? Like, do you think this is even going to be an issue for homeowners?
Well, how many homeowners are completely unlevered?
Well, if I recall correctly, I think, I don't remember the stats, but I think something like around between 30 and 40% of homeowners have no mortgage.
So though you're right, the 30 or 40% who have no mortgage, they're going to be fine. Because even if they lose their job and have no income, well, they can either get a reverse mortgage or they can sell their house and they got lots of money. But it's the people who have a mortgage and the people who have mortgages tied to variable interest rates, which is a significant number of people, or people whose mortgage is renewing. So I said earlier that there's a time lag to all this stuff. If you got a mortgage 2 years ago and locked it in for 5 years, you're fine. Like, it doesn't matter what interest rates are until you renew 3 years from now. But if you went variable, which most people did, well, not most, well, yes, I think
most people did.
Yeah,
in
the majority of the majority of borrowers over the last year or two have gone variable. And, frankly, going variable over the last 15 years was the correct answer, because we've been in a declining interest rate environment. But eventually you get to zero and you start bouncing back up. So when you do the math, and I'm just going to make up numbers and you can correct me with more accurate numbers, but it would be very common for someone to go who had a mortgage payment at the start of 2022 of $2,000, it could very easily be $3,000 now.
Yep.
Very easily. Wouldn't be hard at all. And so an extra $1,000 a month in mortgage payments. Did your pay go up by $1,000 after tax? Probably not. So that's where you get the squeeze. So even the normal person, I'm not talking about the real estate investors and all that, and we can talk about them, but even just the normal person with a normal house, a normal mortgage, or a condo, they are now being squeezed. Not all of them yet, but with each passing month, it gets a little bit worse, a little bit worse. And that's kind of where we are, I think, that they're just getting more and more squeezed. So with each passing month, there's more and more people who have to fund a greater deficit than what they had before. And I think, that's why 2023 is not looking great from that point of view.
Okay, totally agree with everything. So I have a hypothetical question. I'm just trying to run an example just to see at which point would you be able to come in and possibly help somebody, because
Okay.
I want to talk about end users specifically. Forget investors. For investors, there's just one exit. You pull the parachute and you're out.
Right. Yep.
Let's assume I'm a homeowner. My mortgage is not doubled, but whatever. It's gone up significantly. And obviously that's not the only pain point, because everything else has gone up significantly. My groceries, my utilities, gas, whatever. And let's say I also have outstanding debt. I have car debt or whatever, credit card debt, whatever the case may be. I have now by default I'm not able to service all my payments. So right then I'm going to probably start just making the minimum payments on my credit card. Maybe something is going to slip through. But even though I have equity in my home, I don't want to sell it because I have nowhere to go to live. But if I sell it, it will eliminate all of my problems. So, and then the other thing is, I don't know if there's much a mortgage broker can do for these people at this point in terms of refinancing, because you probably already have a rate that is better than if you refinance right now with whatever. So then my question is, are you able to help these people? Because I think this is likely the most common homeowner situation.
You're right. And what you're describing is that middle zone where people are basically screwed.
Yeah.
That's the legal term for it. You're screwed. So, and I have this conversation with people all the time, exactly what you described. Someone comes in to see me and I've got a house, but I am now cash flow poor.
Yes.
House
exactly.
rich, but cash flow poor. And so I say exactly the same thing to them. I say, you know what? Best answer, sell your house. Because if you think the real estate market will either stay the same or get a little softer in 2023, then now's the time to sell. Maybe not right at the height of the winter, but now's the time to sell because you're getting the money out. But they say exactly what you say. Well, but where am I going to live? And I've got a dog and 2 cats and a goldfish and a kid, and I want to stay in the same school district where my kids are and all the rest of it. And I say, well, you got a choice. You can sell the house, and if you sell the house while there's still some equity, then it is possible to rent a place. It's not like there's no rental accommodation anywhere in Ontario. Yes, it might not be as nice as what you've got. Maybe it'll be nicer. I don't know. But if you sell a house and end up with $100,000, that'll pay the rent for a couple of years. And you pay off your debts and you're back on your feet. Now, your question was, okay, but I don't want to sell my house. Okay. So then what we could do is go to your creditors and see if we can make a deal. So let's do some hypothetical examples here. Guy's got a house worth $1 million and he's got a $800,000 mortgage on it, 80% loan to value. So my first advice would be, well, see if a mortgage broker can lend you the $50,000 you need to pay off your credit cards. But, that may be possible or that may not be possible. Because, if we don't want to go above 80% loan to value, then there is no equity in the house. Or sure, you can find some B lender who's willing to do that, but the interest rate, it's going to be a 1-year loan and it's going to be 15%.
Yeah.
Well, if the real estate market's going to bounce back in a year, then that's what you do. If you think it's going to continue eroding, that's not what you do. The problem is, let's say you decide you can't refinance. We go to the creditors and we say, look, I owe you guys $50,000. I've got $200,000 of equity in my house. I'd like to make a deal. And the creditors are going to say, why would we make a deal? Because if you don't pay us, eventually we're going to take you to court, sue you, get a judgment against you, and put a lien on your house. And so we will eventually be able to unlock that $200,000 of equity. So the only deal the creditors might be willing to accept is everything. Okay, so you owe $50,000. We'll do a deal where you pay back $50,000 over the next 4 or 5 years. Does that really help you though? Because $1,000 a month for 50 months is $50,000, but you're already constrained on cash flow. Do you have an extra $1,000 to be servicing that debt? Probably not. And the creditors aren't going to accept $20,000. when they know there's all that equity there. So that's the person who's in that really difficult zone where there is no obvious answer for them. So again, when they come in to see me, I'm going to say, well, do you have the ability, selling your house is mathematically the correct answer. Do you have the ability to borrow from family? Maybe your father's got money and he can put a second mortgage of 50 grand on your house and we use that to service the proposal. Maybe you rent out the basement or something like that. And so we look at all the different options there to see if there's anything that can be done. But it is a very difficult situation.
And this is, everything you described, it's unfolding in front of me, unfortunately, for some people. And I've been kind of called in. It's like, hey, should I list or should I do? Not should I list? They already know they should list. I'm not there to convince them what to do. In the event you decide to list, I'm here for you. But the part I feel bad about is that the writing is on the wall. People see it, but they cannot act. Nobody wants to be proactive. And this is the same thing I've dealt with on people who cannot close on their pre-construction units. They don't want to sell at a loss and lose the deposit. They're basically waiting until the absolute end, because if you sell before, you're crystallizing the loss. You have accepted defeat and you're done and you're losing the money. They wait until the absolute end, where potentially the damages are going to be much worse, but they're going to then deal with the lawsuits and whatever happens with the builder. So this is kind of what I see. Everything is headed in that direction, and nobody wants to be proactive. And I mean, at the same time, I can't blame them. I mean, who wants to lose their house? It's not necessarily the best socially, the stigma that comes attached to it. And then what do you do? So this is why I was kind of trying to figure out if there's a silver bullet. And I think the silver bullet is you have to have conviction in what's going to happen one way or another, and then you have to act on it. But I think not acting on it is likely going to have the worst result for you financially. I mean, unless the real estate market does something crazy and actually turns around, which, I mean, I don't see how that happens, but I think that's what some people are holding on to. They're just saying, if I can last until rates come back down, which, I mean, do you think they're actually going to come down anytime soon? Probably not. So then what do you do?
Right. And that's why it helps to take a look at the long-term charts that you and I were just looking at. And you can do the same with the real estate market. Pull up, the average price of a house in Toronto over the last 30 or 40 years, and you'll see the same pattern. They go up and they go down, and then they go back up again. So if you bought a house in 1989, you could have held that house for 7 years and sold it and lost money.
Yeah.
So, I mean, if you bought Amazon stock in, I don't know, the year 2000, it took 10 or 12 years for it to get back to where it was. I just made that up. People can fact check me to see if that's true or not. But I think number one, you have to have a longer term perspective on it. So this house you're living in now, are you sure you're going to be at the same job for the next 10 years, which is what it might take for the real estate market to come back? Are your kids going to be the same age for 10 years? Is everything going to be exactly the same? Or are you going to be able to work from home somewhere else and maybe you can move somewhere else? But you hit the nail on the head. Do you crystallize the loss today, or do you potentially crystallize a bigger loss tomorrow? That's your choice.
Yeah. And that's why you're right when you said you are officially screwed. Because
yeah, that's it. Do you sell the stock today in the hopes that, well, on the assumption that it's going to keep going down, or do you hold it on the hopes that there's some big kind of rebound? And I think we got to be realistic about this here. What are the chances that either the Fed in the US or the Bank of Canada is going to start lowering interest rates anytime soon? And in my opinion, and I'm not an economist, I just play one on podcast, but I can't see any scenario outside of some black swan event where that happens. Inflation is still high. Unemployment is still low. And I believe the most recent numbers were just released today as well on Canadian unemployment, and it looks even better than everybody thought.
Yeah.
Now, I think there's a lot of play in those numbers, because if a bunch of people have left the workforce because, you know what, screw this, I'm taking early retirement, I'm not going back to work in a restaurant where I got to wear a mask and I got to do this and got to put up with all the crazy customers and everything. If you have fewer people in the labor force, then that makes the unemployment rate look better. And there's absolutely no doubt that the labor force participation rate has been falling for a couple of decades now. So I don't entirely buy into the unemployment numbers. In addition to that, for the unemployment numbers, what's the difference between someone who works 30 hours a week and 40 hours a week? Well, they both have a job, but I would think in terms of spending and a whole bunch of other things, that's not the same person. So in the US, they have two different surveys, the household survey and the establishment survey. One of them is counting jobs. One of them is counting people who have a job. They produce very different numbers. In Canada, I believe we only have one metric. But anyways, the point is you've got to take a look ahead and say, well, what are the chances that inflation comes way down and unemployment goes way up, which is what's going to be required for the Fed in the US and the Bank of Canada to lower rates? I don't see that happening in the next 15 minutes. I don't see that happening in the next 3 or 4 months. If I had to guess, and I've never been right, so nobody listening to this should pay any attention to my projections here, but it would not surprise me to see another 1 or 2 rate increases in January, February, March. Maybe it's only 25 basis points, but it wouldn't surprise me to see that. And then it wouldn't surprise me to see we stay where we are for a number of months. And maybe by the end of 2023, when it's obvious we're in a recession, it's been officially declared, maybe that's when they start to ease. So if I'm correct on that, if unemployment, which is very low now, has only one way to go, if unemployment starts to pick up and if interest rates stay the same or go up a little bit, under what possible scenario can real estate prices go up?
I agree with you. Well, by the way, I want to just give you credit here. So I looked at your prediction and I tallied up what you got right or wrong from last year. So I think there were 4. So inflation high, you were right. You did say that you thought there's going to be deflation towards the end of 2022. So you admitted you didn't get that one.
I was wrong on that one. Definitely wrong on that one.
But you did cite some good excuses, which I'll give you. The war in Ukraine and the supply chains. I mean, that was kind of odd. Nobody saw that coming. And then the one that was pretty good, it was the insolvency. So you predicted 20% increase. Actual was 17.6. So I thought that was pretty good. So yeah, I think you do have a half decent track record. I mean, it's better than mine. Mine is closer to 0. But let me ask you my final question. And this is, I try to use probability when I answer people's questions because I think it helps them contextualize. So when somebody asks me, what's the market going to do? Obviously, I have no idea. But what I try to do is give them kind of like a probability. And I do this with market value of houses when people ask me, what should I list and blah, blah, blah. And I kind of have a little bit of a formula I make to this, but I'll give you an example of kind of how I'm going about the future. And then you tell me your numbers. So not for all of 2023, but in terms of where we end up at this time next year, I think the probability of higher prices than today, I'll give it a 5% probability. In terms of prices being the same or within a 5% band, I give that about 40%. And the probability of prices actually being 5% or lower than we are today, I give that a 45% probability. So basically 5, 40, and 45. But effectively, I'm saying 95% we're going to be either the same or worse than where we are today. So if you had to put probabilities on those 3 buckets, how would you bucket them?
Yeah, I think I would bucket them pretty much the same. I mean, I would say my first bucket may be closer to 0 than 5%.
I have to be a little bit optimistic as a real estate agent. That's the only thing.
Right. And I think it's wise to put a range on it because what is the black swan event that happens in 2023?
Yeah.
So we had this war that I did not project. I did not anticipate. Now, I guess if I was smart enough, I could have read the tea leaves and would have seen it coming, but I'm not that smart. So you could certainly have a number of black swan events, though, in 2023. So we could have massive gridlock in the US. We can't even elect a speaker and we got all these other problems and all the rest of it. And that could throw the economy, not just that, but many other things could throw the economy into a deeper recession than everyone expects and a quicker recession, meaning the Fed has to pivot a lot quicker. And if the Fed pivots, well, then maybe that bumps asset prices again. Now, I don't see that happening, but it is not a 0% chance of that happening. What else could possibly happen? I don't know. Maybe somebody invents some easier way to create energy, which somebody will invent, but I don't think it's going to be tomorrow. It might be at some point in the next 50 years. But if something like that happens, well, then boom, we're off to the races again. But I think your buckets are I have no problem with any of those. I would agree with that. If I had to stick a pin in the map, I'd say, okay, well, I would assume that by this point next year, so by early 2024, yeah, house prices will be lower.
Yeah.
I just do not foresee any way that it can be any different than that, which I guess then goes back to your earlier question. If that's the case, and if you're saddled with a bunch of debt now, you would be better off taking the loss now than taking a bigger loss in the future.
Yeah. And I think this is a great way to end it. And unfortunately, I don't think people are going to do that. So knowing they're not going to do that, I do wonder how it's all going to play out. It's going to be very interesting. I think this is now, I need to have a psychologist or somebody on to kind of help them with that question, because to me, it seems the most common sense thing to do, but it's kind of like taking a donkey and just trying to pull them, but they're not coming. They're not coming.
And again, it is psychology, because this is my house.
Yeah.
This is where I live. This is where my kids live. And again, I have this conversation with people all the time, and they say, but my kid is just started high school. And for me to uproot them now in the middle of the school year, and we're going to have to live somewhere across town because we can't afford to live where we're now. And that's going to, I just don't want to put my kid through that. Okay, I understand that. Or I've got small children, daycare is right there. We've got a dog. I can't move into a rental apartment. Where we're living now, I don't need a car, but if I was to move outside, I would need it. I mean, there's a whole bunch of these factors. My mother lives with us. Where would she go? My 24-year-old kid is still at home. Well, that's an easy one. Kick your kid out. There's no problem with that one. But I get it. These are real problems. It's okay if you're single and living in a condo, and fine, you can go live somewhere else. But it is difficult. So I never tell people what to do, because I don't know. I just say to them, well, let's consider the different alternatives, and then you make a decision. Yeah. So what happens if the last 6 months is repeated again, and house prices are 10% lower by the time we get to the summer? And then I shut my mouth, and I just sit there, and I have an uncomfortable silence, but I don't say anything. And then I say, okay, well, we can't talk about this in nebulous terms. If you had to move in the next 3 months, where could you live? I don't know. Well, have you looked at the rental listings? You can actually talk to a real estate person, and they can tell you places to rent as well as places to buy. And I actually had this discussion, I remember very distinctly, with a client of mine, the house, the kid, the dog, the whole bit. They ended up finding a house to rent on the same street they lived on. And it just so happened that this person had to go on got a work placement in some other country for the next 2 years. So they were able to rent a house almost identical to what they had for the next 2 years at roughly the same as what they were paying on their mortgage, but they were able to sell the house, cash in, pay off all the debts and everything. So until you actually look, don't tell me you can't find a place to rent. Actually go look. And then you're comparing apples to apples, not some theoretical thing. But again, I will echo what you said. It's very difficult. This is not easy. It's easy for us to sit here on a podcast. Oh, you just sell your house. I get it. It's really difficult. But the alternatives are also really difficult. So you got to pick one.
Yeah. Pick your poison, I guess.
Pick your poison. Yep. That's it.
Okay. Well, that was great. Thank you so much. This was very helpful. And I hope it just brings another perspective to people, just so that again, once you're in this position, you have to make this, it's probably easier. All things with all the information we have as of today, I think the decision for me is clear, but obviously you have to overcome your personal hurdles before you do anything.
Yeah. And that's why people should reach out to professionals. I mean, obviously, if you talk to a real estate agent, they want to sell you a house. If you talk to a mortgage broker, they want to get you a mortgage. If you talk to a insolvency guy, they want you to do a proposal. Like we've all got our biases. So you got to filter through that. But you talk to an insolvency guy and say, okay, what would it cost me to file a proposal? You talk to a mortgage broker and say, okay, what would it cost to refinance, get a second mortgage, talk to my bank about a HELOC, talk to a real estate person about selling, and maybe you got to talk to a couple of them. But then you've got actual numbers you can look at. What would it cost to rent a place? And then you can make a decision based on at least some projections of facts rather than purely your gut level emotion, which tends to be the wrong way to make financial decisions.
Yeah. One last question that just popped into my head. I just remember reading this. I'm pretty sure I know the answer, but in the event you declare bankruptcy, your mortgage is discharged, but right? Or is that not right?
No.
Okay.
No. So bankruptcies and consumer proposals deal with unsecured debt. So going back to that chart we looked at back in 2011, a third of my clients owned a home at the time they filed a bankruptcy or a proposal. And in most cases, they kept the home. I didn't take it because the equity wasn't high enough. There was basically break even. The bank doesn't care. The lender doesn't care if you're bankrupt or in a proposal, so long as you're making the payments. Now, if you're behind on the payments, then they definitely care. But there's a specific section of the Bankruptcy and Insolvency Act that says if you are up to date with your secured creditors, mortgage, car loan, that sort of thing, then they cannot cancel your contract just because you filed bankruptcy. Now, of course, when the mortgage comes up for renewal, that's a totally different story. So if the mortgage is coming up for renewal 6 months from now, while you're still bankrupt, then the bank may say, oh, you're a way higher risk now. We're going to jack up the interest rate. We're not going to renew, whatever. So it's not a guarantee that you can keep your house forever. But in the event of a bankruptcy or a consumer proposal, if your payments are up to date, the lender will allow you to keep making the payments until there's some other event of default in there.
And what if it's a position where a power of sale was forced on you, you owe more in debt than what was liquidated after all fees, and then you go bankrupt because they're trying to chase you for the difference, and then you go bankrupt at that point. Are you then on?
And that's exactly what you do. You would go bankrupt at that point because at that point it's an unsecured debt.
Okay.
The house is gone now. So this is something we saw much more frequently 20 years ago, where, okay, I can't make the payments. I walk away from the house. It takes the bank 6 months to a year to sell it because there's a power of sale proceeding. They got to do all the legal stuff. And so the bank is incurring costs during that period of time. They got to keep the hydro on. They got to cut the grass, shovel the snow, whatever. They finally end up selling it. Of course, they got to pay legal fees and real estate fees and all the rest of it. There ends up being a shortfall of 50 or $100,000. So yes, at that point, the lender is then coming after you. Now, typically what would happen in Canada is CMHC or the other mortgage insurer picks up the loss for the bank if it was an insured mortgage. And so it's CMHC who's coming after you, not the bank, because the bank got paid out. And in my experience, haven't had much of this over the last few years for the reasons we talked about, but I remember 10, 15, 20 years ago, it would take CMHC years to come after someone. I dealt with all sorts of people who had this, CMHC suing me for $100,000 because of my house. Oh, when did they take the house? 10 years ago. Okay, they're really fast, aren't they? So, but CMHC, of course, because they're kind of quasi-government, they can be taking your tax refunds, that sort of thing. So yes, I think if you and I are having this discussion a year from now, when the real estate market potentially is even lower than what it is today, then there will be people who will be walking away from their properties. And in fact, I've had a few calls from people who bought their condo in February of 2020. The closing date was April of 2020. And so they were already underwater when they took possession. And in some cases, it's like, oh, you know what? I didn't qualify for the mortgage I thought I was going to qualify for. Certainly, if you bought it in February of 2022 and the closing was in May of 2022, okay, you might be screwed because interest rates had gone up, the value of the property has gone down. You go to the bank and the bank says, oh, sorry, we're not giving you the mortgage. or certainly not at the terms we were originally going to give it to you for. So now you're underwater right from the beginning. There will be, I think, an increasing number of people who will say, here's the keys, forget it. I'm not even closing. I can't close. I can't get the mortgage. So now the seller is coming after you for the shortfall.
A lot of that happening now.
Yep. And I'm not seeing it at my end yet to a great extent because of the time lag. So if you were supposed to close December 1st and you didn't, so now the seller has to relist the property, and it might be March or April before they find someone to buy it, and it might be $100,000 less than you were going to pay for it. So then once the deal officially closes and they crystallize their loss, then they go through the process of suing you for it. So it might be December of this year before the lawsuit is up and running, and that's when the person's coming in to see me. So all the deals that are defaulting now, I will be seeing them in the next 6 to 18 months when the judgments happen.
Yeah, and this is where I'm seeing, from my experience, at least the stuff, I don't have much exposure to it, but I have definitely talked to a few people in this position right now that have walked away, and that's being rather on the buy side or the sell side. What the good lawyers will try to do first, they will try to negotiate a remedy, even if it's maybe half, because everybody knows what happened. So maybe half. And then it just comes down to the buyer's profile. If they have assets and they're not high risk of bankruptcy, they'll negotiate. And if they can't come to terms, they will go after them. But if they're high chance of bankruptcy, they have no assets, I think they would probably be seeing you, or I'm not sure how exactly who would come, but yeah, they would probably just, escape.
Right. And that's the correct business decision. So if you're the person on the other side, the seller who isn't selling now because the deal doesn't close, is it really worth it to spend a whole bunch of money on lawyers, dragging something through the courts for a year, incurring $10,000 or $20,000 in legal fees, only to have the person go bankrupt at the end anyways, and you get nothing? So I totally agree with you. What a good lawyer would do would be figure out, okay, what's the most we can get here? And it might mean you're going to lose 50 grand, but if we can pick up another 50, so you're not losing 100, that's a better deal. But again, it's emotion, right? I've already bought my new house. And so now I've got to come up with money to buy my new house because you didn't close. So I don't care what the cost is. I'm going after you right till the end. That unfortunately is what I suspect will happen in many cases. But yes, a negotiated settlement is almost always the best answer.
Yeah. Yeah, it seems like that's the golden ticket for a pretty bad situation.
Yep, absolutely.
If you got value out of this video, please like and subscribe to the channel. This gives me the feedback I need to know what kind of content to give you. And if you have any questions, feel free to email or text me, and I'll be happy to help you.